All right, let's dive in. We're looking at the stock market today,
Oh, yeah.
but from a different angle.
Interesting.
Everyone's talking about stocks going up
Yeah.
and all that good stuff. But we're going to see if maybe there's some signs that maybe it's not all
Not so fast.
rosy.
Exactly.
Yeah. So the bond market might be saying something a little different.
Okay.
So we found this article in The Motley Fool.
Oh, yeah. The Motley
It came out just yesterday,
Okay.
January 16th, 2025. So it's pretty fresh.
All right.
And the title's a little bit provocative.
Okay.
Think the stock market will soar again in 2025. The bond market could be signaling otherwise.
Interesting title.
Yeah. So, the stock market
Right.
had a great year last year.
It did, yeah.
The S&P jumped 23%,
Wow.
which is huge.
Yeah.
But the bond market's maybe saying, hold on a second.
Okay, so before we get into what the bond market is saying,
Yeah.
can you remind me what bond yields are and why I should even care?
Oh, yeah, sure.
Okay.
So bond yields are like,
Okay.
the return you're going to get on your bond.
Like interest on a savings account.
Exactly.
Okay.
And the thing about bond yields is they move in the opposite direction of bond prices.
Oh, that's right.
So if bond prices are going up, yields go down,
Okay.
and vice versa.
Okay.
So if yields are going up, that means prices are going
Down, yeah.
down. Exactly.
Okay, and what are yields doing now?
Well, that's the thing.
Yeah.
They're going up.
Really?
Yeah, even though the Fed has cut interest rates 3 times.
Since when?
September.
Of last year?
Yeah.
That's strange.
It is strange, right?
Yeah, because usually when the Fed cuts rates, bond yields go down.
Yeah.
So what's going on here?
Well, the Motley Fool thinks that bond investors are kind of maybe anticipating that there might be some inflation on the horizon.
Oh, interesting.
Yeah.
So like that crazy inflation we saw back in the 70s.
Not necessarily like runaway inflation,
Okay.
but definitely some things that could cause some price increases.
Okay, like what?
So they're pointing to a second Trump administration and some of the policies that might be put in place.
Yeah.
Tariffs.
Tariffs, okay.
Potentially.
Yeah.
Really big tariff, like 20% tariffs.
Wow, 20%
Yeah, across the board.
on everything.
Yeah, or even higher for some countries.
Oh, wow.
Also tax cuts
Tax cuts? Okay.
and some potential changes to immigration.
Interesting.
So all of those things
Yeah.
could contribute to.
Okay, but how do those things lead to inflation? I'm not quite seeing the connection.
Okay, so let's take tariffs, for example.
Right.
Imagine you go to the grocery store
Okay.
and your favorite coffee,
Yeah.
which is imported,
Right.
suddenly costs $1 more.
Oh, because of the tariffs.
Is it a tariff? Yeah.
Okay, so that's a direct impact on prices.
Directly. Yeah.
Okay, I get it.
And then tax cuts are a little trickier
Right.
because it seems good.
Yeah.
Right?
Yeah, more money in my pocket.
More money in your pocket.
Right.
But if everybody has more money in their pocket,
Yeah.
demand goes up.
Okay.
And if demand goes up faster, then supply can keep up.
Then prices go up.
And prices go up.
Okay.
So that's how that can lead to inflation.
Gotcha.
And then immigration,
You're right.
that can affect
Yeah.
the labor market.
Okay.
So depending on how those policies are implemented,
Right.
that could affect wages
Okay.
and also the cost of
Goods and services.
goods and services. Yeah.
Okay, so it's like a chain reaction.
It is, yeah.
Interesting.
So bond investors
Yeah.
are seeing these potential policies
Right.
and thinking this could lead to
Inflation.
Okay.
Inflation, and they're adjusting their bond holdings accordingly.
Exactly. Yeah.
Like they're seeing something that maybe stock investors aren't.
It's like they have a little inside scoop.
Yeah.
So how does this all affect stock investors like us?
Right. Good question.
Is inflation always bad for stocks?
That's a good question.
I mean, some companies
Yeah.
can raise their prices, right?
Right. Some companies can just pass those price increases along to their customers,
Exactly.
but others might have a harder time doing that.
Yeah.
And that could squeeze their profit.
Right.
And then if inflation really starts to heat up,
Yeah. The Fed might have to, reverse course,
stop cutting rates
stop cutting rates, or even
or even raise them again.
raise them again. Yeah.
Yeah, that would definitely make things harder for the stock market.
Yeah. It would definitely change the environment.
Definitely.
Yeah. So there's definitely something to keep an eye on there.
Yeah, for sure.
So is there anything else in the article
Yeah.
that
That bond investors are worried about?
that bond investors are
Yeah.
concerned about? Yeah, there's one other thing that they point to.
And it has to do with
Oh, so yes,
valuations.
Valuations, okay.
Yeah, they're saying the S&P 500's earnings yield.
Earnings yield, remind me what that is again.
Oh, yeah, sure.
Okay.
So earnings yield is basically
Okay.
a way to measure
Okay.
how much profit a company is making compared to its stock price. So a lower earnings yield suggests that maybe the market is a little overpriced.
The market might be overpriced. So what are they saying about earnings yield right now?
Well, they're saying that it's really low.
Really low.
Yeah, like the lowest it's been since 2002.
Since 2002, that's a long time.
Yeah.
And how does that compare to bond yields?
Well, that's the thing. Yeah. It's lower than bond yields.
So what does that mean?
Well, it means that from a valuation standpoint, bonds might look
more attractive.
More attractive than stocks right now.
Okay, now that's interesting.
So the bond market is basically saying, be careful with stocks.
Proceed with caution.
Proceed with caution, yeah.
Exactly.
Okay, so what does this mean for income-focused investors?
That's a great question. Yeah. And we'll get into that right after the break.
Sounds good.
So for those folks out there who are really focused on that income.
Yeah.
You know?
The steady stream of payments.
Yeah, exactly.
Yeah.
What does the Motley Fool have to say to them?
Well, it might seem kind of counterintuitive.
Yeah.
Given how hot the stock market has been.
Right.
They're actually saying this might be a good time to tilt more towards bonds.
Really?
Yeah.
Because of those higher yields.
Exactly. Those higher yields mean higher payments.
Right.
And that's what income investors are looking for.
Yeah, and wouldn't a cooler stock market actually help them in the long run, too?
Yeah, potentially.
I mean, if prices came down, then they could buy in at a better price.
Exactly, and lock in some nice dividend yields.
Yeah, that's a good point.
So it's kind of like a win-win.
Interesting.
Yeah.
So what about the rest of us? Like the folks who are more interested in growth and, you know, just building long-term wealth.
Yeah.
Should we be worried about these bond market signals?
Well, the Motley Fool is really emphasizing that long-term perspective.
I get that. But it's hard not to get a little spooked when you hear, you know, these warnings.
Yeah, but we got to remember the bond market isn't always right.
That's true.
You know, it's just a bunch of investors making educated guesses.
Right.
Based on what they're seeing.
Things can change.
Exactly. Things can change. And sometimes they're wrong.
Yeah. And historically speaking, hasn't the stock market always kind of rewarded those patient investors?
Yeah, long-term investors tend to do well. You know, even with the ups and downs.
So are we just supposed to ignore these bond market warnings and just keep buying stocks?
Not necessarily ignore them. You know, they're giving us valuable information.
Right.
But they're not the be-all, end-all.
Gotcha.
The Motley Fool does have some specific advice for long-term investors.
Okay, what is it?
They're saying, given this potential for a correction, we should be extra careful about valuations.
But not just buying whatever stock is hot at the moment.
Exactly. We got to do our research.
Oh, right.
Look beyond the hype.
And make sure the price is justified.
Yeah, exactly.
Okay.
Look for companies with strong earnings.
Yeah.
Consistent growth.
Right.
A good track record.
So basically, be more selective.
Be more discerning,
Don't get swept up in the frenzy.
Exactly. Yeah. The Motley Fool also recommends focusing on companies with strong growth potential.
So companies that are innovating.
Yeah, innovating, adapting.
Like they can weather any storm.
Exactly, like they have a backup generator.
I like that.
Yeah.
So it's all about building a portfolio
Yeah.
that can handle whatever the economy throws at us.
That's the goal.
This is great advice.
Thanks.
I'm really curious to get your take on all this.
Sure.
You know, you have so much experience looking at markets and the economy.
Yeah.
What's your gut feeling about what's happening?
Well, it's important to remember.
Okay.
Markets are complex.
They are.
Yeah, you've got all these different factors.
Right.
Political events.
Economic policies.
Investor sentiment.
It's a lot to keep track of.
It is. And they can be really unpredictable.
Like, we can't say for sure how a second Trump administration would actually play out.
Exactly. We don't know exactly what policies they'll implement.
Or what will happen in the global economy.
Right. It's like trying to predict the weather 6 months out.
Yeah, that's a good analogy.
Yeah, but that doesn't mean we should just give up.
Right.
We can't control everything.
Yeah.
But we can control how we react.
So how do we navigate all this uncertainty?
One of the most important things is to stay informed.
Okay.
And diversify.
Diversify. That's the classic advice. But I'm curious how that actually helps in this specific situation.
Well, think of it this way.
Okay.
Diversification is like building a shock absorber for your portfolio.
Mm-hmm.
So if one asset class takes a hit, the others can help cushion the blow.
So even if stocks go down,
right,
maybe my bonds or real estate will hold up.
Exactly.
And I won't lose everything.
Right, it helps to spread the risk.
Especially when things are so uncertain.
Exactly.
Okay, that makes sense.
So given all these mixed signals,
yeah,
do you think we're headed for a major correction? That's the big question, isn't it?
It is.
Unfortunately, I don't have a crystal ball.
Right.
But I can say, historically, periods of rapid growth are often followed by some sort of correction.
So you're saying it's likely?
It's definitely a possibility.
Okay.
But we got to remember, corrections are normal.
Okay.
They're part of the cycle.
Right.
They can be scary.
Yeah.
But they also create opportunities. Well, you can buy stocks at lower prices.
I see.
So it's not about avoiding corrections altogether.
Right.
It's about managing the risk.
And being prepared.
Exactly.
And that's where diversification comes in.
Exactly.
This has been so helpful.
I'm glad to hear that.
I feel like I have a much better understanding now of what's going on.
I want to leave you with one final thought, though.
Okay. I'm intrigued.
What if the bond market is pointing to something even bigger?
Bigger than a correction?
Yeah.
Like what?
Like a fundamental shift in the economy. A change in how we think about growth or inflation or even global trade.
Wow. Those are some big questions.
They are.
We might need a whole other deep dive.
Maybe we will.
To explore those.
But in the meantime, I think it's worth thinking about.
Absolutely.
Yeah.
Okay, so before we wrap up,
yeah,
let's just do a quick recap.
Sounds good.
Of what we've learned today.
Okay.
So first off, we got this interesting situation where the stock market seems to be going strong, but the bond market is saying, not so fast.
Be careful.
Yeah, proceed with caution.
Right.
And that's because bond investors are worried about inflation, and they think a second Trump administration might make that worse.
Right.
With policies like
tariffs,
tax cuts,
immigration changes.
Yeah, all those things could potentially lead to higher prices.
Exactly.
And we also talked about that earnings yield being low.
Right, really low.
Compared to history.
Yeah, the lowest it's been in over 20 years.
And compared to bond yields.
Yeah, which is making bonds look more attractive.
Right, so it's all about valuations.
Exactly.
And making sure we're not overpaying for stocks.
Yeah.
And then the Motley Fool gave us some specific advice for different types of investors.
Right, for income investors.
They said,
lean into bonds.
Yeah, take advantage of those higher yields.
Okay.
And for the growth investors, they said,
stay the course.
But be careful.
Be selective.
Do your research.
Look for strong companies.
Right, companies with good fundamentals and growth potential.
Exactly.
And no matter what your investment style is, remember to diversify.
Always diversify.
And thread that risk around.
Like a safety net.
I love it.
Yeah.
This has been such a great discussion.
It has.
I feel like we've really covered a lot of ground, and I'm definitely walking away with a lot to think about.
Good.
So, to all our deep divers out there, keep those minds curious.
Keep exploring.
And we'll see you next time.
See you next time.
So what's that big question?
Well, could the bond market be hinting at something even bigger?
Bigger than a correction.
Yeah, like a fundamental shift.
Like what?
Like a change in how we think about the economy.
How so?
Maybe a change in how we think about growth.
Okay.
Or inflation. Or even global trade.
Wow, those are some big ideas.
They are.
We might need a whole other deep dive.
We might.
Just to unpack all that.
Yeah, but for now, just something to think about.
Okay, I'll definitely be pondering that.
Good.
All right, well, before we wrap up, let's do a quick recap.
Sounds good.
So we started with this kind of strange situation where the stock market's doing great.
Seems to be.
But the bond market's saying,
not fast.
Be careful.
Proceed with caution.
And that's because bond investors are worried about
inflation,
right?
Sure.
And they're concerned that a second Trump administration might, exacerbate that.
Potentially.
With things like tariffs.
Tariffs, tax cuts.
Immigration changes.
Yeah, all things that could push prices up.
Exactly.
Yeah.
And then we talked about that earnings yield.
Right, how it's super low.
Historically low.
And lower than bond yields.
Which makes bonds look pretty attractive right now.
Yeah, at least from a valuation perspective.
So it's all about making sure we're not overpaying for those stocks.
Exactly.
And the Motley Fool had some specific advice for income investors, they said.
Take advantage of those high bond yields.
Yeah, lean into bonds.
Exactly.
And for those long-term growth investors.
You said stay the course.
But be careful.
Be selective.
Do your research.
Choose those strong companies.
Right, with good fundamentals.
And growth potential.
Exactly.
Yep.
And then no matter what your style is.
Diversify.
Always diversify.
Spread that risk.
It's like a safety net.
It is.
I love that analogy.
Yeah.
Well, this has been a fantastic discussion.
It has been.
I feel like I've learned so much.
Good.
And I'm walking away with a lot to think about.
Good. That's the goal.
So to all our deep divers out there,
keep exploring.
Keep those minds curious.
And we'll see you next time.
See you next time.